And number 4, learn how to analyze stocks. It's easy to assume that investing is complicated when you look at all these complicated charts. But investing at its essence is simple. You have to find out the value of a certain company and compare it to the price that it's traded in the market. If it's traded at a lower price, then it's a good investment since it's undervalued. And if it's higher, then it's a bad investment since the stock price is overvalued and at some point in the future, the price will rise or drop to its real value. The challenge is to learn how to analyze stocks. For example, there is price to earnings ratio, which we have covered in a previous video. How much you will be paying for each dollar that the company earns if you buy that stock. Or price to book ratio, to compare a firm's market capitalization to its book value to find out how much the company is going to earn if it sold all of its assets and paid its debts. Or debt to equity ratio to find out to what degree the company is financing its operations through debt versus its own funds. If the company is debt-free, then it's not taking full advantage out of its resources. Tesla, for example, has the technology to build electric cars, but it can only build a limited number of cars since it has only a certain amount of cash. But it can borrow money at a very low rate of 2 to 3% and have a rate of return of 10 or 15% on that borrowed money by building and selling more cars. So if it's not doing that, then it's clearly missing an opportunity. But there is just so much demand in the market, so if it borrows too much, it might not be able to sell enough cars to make interest payments and might default on its loan. But it's not enough to look at the financial statements. The management that runs the company is equally important. How the company is planning to double or triple its valuation is one of the factors you should be looking at. So before buying a stock, you have to analyze it from the top to the bottom.